Hello, everyone. Today, we're talking about one of the most misunderstood words in investing, diversification. Because most people hear diversified and think, I own a lot of stuff. I own US stocks, international stocks, bonds, maybe real estate, maybe some private investments, maybe a few alternative funds. But the better question is not how many things do I own? The better question is, what risks am I actually being paid to take? For this conversation, I have with me Henry Mercer, who is a strategic leader of the firm, responsible for overseeing the firm's investment philosophy and portfolio management process. And Henry and I are joined by Allen Steere. Allen is a portfolio manager at Stone Ridge Asset Management and the head of the Stone Ridge Diversified Alternatives Fund, SRDAX, which I believe the cool people call it SRDAX, which is a multi-strategy alternative mutual fund with over $2.2 billion in assets. And Allen has one of the more interesting backgrounds we've had on the show. Before joining Stone Ridge in 2015, he was a single stock equity derivatives trader at BNP Paribas, where he traded and risk managed a portfolio covering more than 100 US companies, including both listed and over-the-counter derivatives. But before that, and this is where the story gets especially fun, Allen spent 11 years as an airline pilot. He started flying for Continental Express and later became a captain and lead check airman at JetBlue Airways on the Embraer 190. Hopefully I said that right. So between flying commercial aircraft, managing derivative risks, and now running a diversified alternative strategy, Allen has spent a good portion of his career thinking about risk, systems, discipline, and what can go wrong when people get overconfident. Allen earned his degree in psychology from Ohio Wesleyan University and is also a CFA charter holder. Allen, welcome to the show.
A pleasure to be here, Austin. Thanks very much.
Of course, of course. So before we jump into investing, I have to ask, how does someone go from a psychology major to airline pilot to derivatives trader to alternative portfolio manager? That sounds less like a resume and more like 3 different dads on career day. Can you walk our viewers through that transition?
Sure. I think that I always just pursued things that I thought were really interesting. And ultimately things that play to my skill set. I think particularly if you think about the career as an airline pilot and then risk managing a big derivatives portfolio at a bank, and then on to managing a multi-strategy alternative mutual fund, the consistent theme through that is an aptitude for risk management and kind of an aptitude for judgment as well. Broadly speaking, all of those things require risk management and judgment and kind of a healthy and ongoing question about what exactly could go wrong and trying to mitigate and manage those things in a way that kind of satisfactorily strikes the balance between, in the case of managing a mutual fund, generating a substantial positive return, but doing so in a way that is, at a risk point that investors will tolerate. If you think about that in terms of what does that have to do with flying airplanes? I mean, inherently, taking that airplane from point A to point B is a risky endeavor, and the job of the captain really is to manage the risks associated with that to a reasonable degree.
Sure.
Austin, I already feel safer. I mean, right. Allen, I think like flying a plane, or I've sailed boats my whole life. It's kind of a great preparation because you can follow all the instruments in the world, but every once in a while you need to kind of go by your instinct, and you're constantly assessing risks. So that's really terrific that you can fly a plane. I'm impressed.
Henry, that reminds me of a funny story from when I was taking some of my flying tests, and the examiner for one check ride in particular was a rather salty old timer, let's call him. And we got out to the end of the runway in this little Cessna 152. For those of you who are not familiar, it's a little 2-seat propeller-driven aircraft. And as we were cleared to take the runway and take off, This gentleman pulled a bath towel out of his flight bag and draped it over the instrument panel of the airplane.
Oh, boy.
Said, okay, let's see you fly this by the seat of your pants. Take me up to pattern altitude and let's get this underway. I did that successfully with a bath towel covering the instrument panel. And I think in the first 30 seconds, basically passed the check ride as a result.
Wow. That's scary. I don't know.
We did not do that in the airline. I want you to know, but.
Just cover and walk. All right. So you traded turbulence in the air for turbulence in the markets, I suppose.
That's an interesting way to think about it, but I think that's an apt description. And in each case, ultimately, you're seeking to mitigate the turbulence of the air and the turbulence, at least that the investors in our funds experience.
Sure. So tell us about Stoneridge. How did the company come about? What does Stoneridge do? What do you guys stand for?
Yeah, so Stoneridge is an asset management firm that is specifically focused on alternatives. We seek to find investment strategies that we think exhibit very low correlation to traditional assets like stocks and bonds. The company was founded in 2012 and has subsequently grown to manage $35 billion across a variety of alternative investment strategies, some of which are mutual funds, such as the one that I manage, but they run the gamut from mutual funds to various SMAs and hedge fund vehicles as well.
Sure. So let's dive in. Let's start with just the word diversification because it gets thrown around constantly, but I'm not sure most investors or frankly, even many advisors define it the right way. A client might say, I'm diversified. I own 10 funds and I own 45 stocks. But if all those investments are ultimately tied to the same economic engine, that may not be as diversified as it looks. So when you think about diversification, what do you mean?
Yeah, I think that what we pay attention to, what it boils down to, if you want to present a single data point, is just correlation. Like that is a pretty good measure of what is, of the diversification potential from a given investment strategy. And, you properly allude to the idea that you can own a lot of or invest in a lot of different things, but those things may have diverse names. They may even say alternative in the name of the thing that you've invested in. But one really needs to pay attention to the correlation in order to determine whether or not that's providing a diversifying return stream. As an example, I think a lot of investors might view that private equity is a diversifying investment for an overall, public equity portfolio. I think ultimately, there's a diversification of form factor. It's probably in a private vehicle versus a S&P 500 index fund. But ultimately, the thing that's really driving returns and the source of risk in a private equity portfolio versus a public equity portfolio is the same. And indeed, the correlation of private equity to public equity is like 80% or so. Statistically, we're saying that's basically the same.
Sure. So would you say, is it fair to say that true diversification is less about the actual label, stocks, bonds, real estate, alternatives, and more about what actually causes the return?
I do think that that's fair. And I also think that when it comes down to it, it's really hard to find investments that actually are diversifying, that have a different source of risk and return than what you would find in a traditional stock and bond portfolio. Stoneridge was founded in 2012. I have 200 colleagues today. We're looking for things that are positive in expectation, regardless of the broader market environment. And we're looking for things that have intuitive rationale for profitability. And we're looking for things that have exhibited a really low correlation to stocks and bonds over time. The potential universe of diversifying and alternative investments is really large. But if you pass it through that three-part filter, there's only a handful of things that you're left with. 14 years after founding the firm, we have about 10 things that we think meet that requirement, and many of which we're able to make available in a daily liquid mutual fund like the one that I manage, but not every single one.
Sure. So let's put a pin in that because I definitely want to jump back into that and really dig into that, because I think there's a lot of good meat there. What I guess I think would be important for our listeners is to, take a step back and say, well, what about stocks and bonds, right? I think for a long time now, the industry has pointed to the classic 60% stock, 40% bond portfolio as the traditional balanced portfolio. And that distribution has been considered a base allocation for a reason. Stocks are the growth engine. Bonds provide income, can add relative stability, and at times be a powerful diversifier when equities fall. But there are two issues investors need to be honest about. First, stocks go through periods of muted returns. Second, bonds are still useful, but they are not the absolute stock hedge individuals sometimes mistake them for. So let's take those one at a time. Allen, when markets are going up, stocks can feel safer than they actually are. Why do you think investors underestimate stock risk during good periods?
I think at least in the current environment, there's a significant amount of recency bias in which there's sort of a view that stocks will always go up, and that even when they've experienced temporary drawdowns, that you just kind of close your eyes and that will pass, and they'll automatically kind of go back to appreciating. And historically, that is simply just not true. They've been certainly valuable investments over time, and they deserve a significant place within an overall investment portfolio. But I think it's important that investors bear in mind that they've experienced positive returns as a result of their equity portfolio because of the fact that stocks can go down from time to time. In essence, that's the risk that is undertaken in exchange for a positive expected return. And I think that in recent times, investors may have lost sight of the fact that there is real risk associated with an equity investment. And you kind of only have to look back as far as COVID to see a very significant drawdown, 30+% in March of 2020, significant drawdowns in the great financial crisis of 2008. Of course, and the biggest example of that now quite a long time ago, but in 1929, when stocks ultimately drew down 86% and took over 15 years to recover from that drawdown. In our view, that cries out for diversification across more than one source of risk and return. And that, in essence, you can feel like you have a very diversified equity holding. Say, if you have exposure to the S&P 500, yes, it's a lot of different names, it's a lot of different stocks, but during periods of equity market drawdowns, it's as if you own one stock. The correlation typically goes close to one, and there's not a lot of diversification that's found within individual equities during down markets.
Stocks go through long-term secular cycles. Right now, we're in what would be more is known as a cyclical bull market. But there are periods throughout history where stocks do underperform, and that period can last a decade. We've seen it throughout investment history. And right now, you can make the case that we have been in a secular bull market overall since 2013, when you went above the peak prior to the great financial crisis. We've gone up basically on a pretty steady uptrend ever since. That's lasted now quite a while. So I think, risk has been raised. And in this environment, people oftentimes, because things have gone so well, they do forget about diversification and, key principles like margin of safety and things like that. So, Allen is very, very correct that there are periods where equities struggle and diversification pays off.
Right. And I think a big mistake for investors is either leaning further into equities because of FOMO. They have this fear of missing out. And then also they look back in the recent past and they say, market actually did really well over the last 3 years. Why wouldn't I add more to equities? And I think the big emphasis in our conversation here is not the people who should be 60% in stocks based on their wealth plan and risk tolerance that are 60% in stocks. The emphasis here is the people who should be 60% in stocks who decide to be 80 or 100 instead, after looking back at the last few years in the market. That's where recent returns can create a false sense of confidence. The stock market starts to feel safe simply because it's been working, and then there's that FOMO I mentioned. You can't stand the fact that you've only captured 60% of the stock market's return over the last several great years. So you want to increase your stock market risk in an attempt to increase that growth potential. But in many cases, the plan for these individuals didn't change. Their true risk tolerance didn't change. Only their confidence changed, or that fear of missing out built up, and that confidence and fear, mostly on the recent performance side, can be very dangerous.
Diversification, I'm sorry, Austin, but diversification helps you manage that fear, because there are very few people who can sit through a bear market and not bail, lose their nerve, get scared to death. I mean, that's where diversification comes in. It allows you to sit through for a long-term purpose.
I absolutely agree, Henry. I think that, Austin, your point about it's that their confidence changed, that can run in reverse very quickly during a period of an equity market drawdown. And the result of that winds up being that you buy high and sell low, which is kind of the opposite of what you're ultimately trying to achieve within an investment portfolio. And a sufficiently diversified portfolio can help protect you from making those kinds of decisions that are just wealth destructive in the long run.
Right. And then, diversification, that brings us to the bond side of the 60-40. The bond side is tricky to talk about because I don't want listeners to walk away thinking, great, based on what everyone just said, I should sell all my bonds. It's not the point. But bonds still play, or can still play, an important role. They can provide income, liquidity, and potential downside support, but they're not perfect. And we don't need to go back very far in history to see that. In 2022, stocks and bonds both struggled as inflation and rising rates hit the traditional balanced portfolio. Vanguard called it a severe test for 60-40. They still argued against declaring this structure dead, though. Then you had companies like BlackRock. They also noted that post-COVID bond diversification has become less reliable, including periods when equity weakness and bond weakness occurred together. In a recent publication that they put together this year, they cited that since 2020, there have been negative bond returns in 17 of the 19 months when equities were down 2% or worse. So, Allen, how should investors think about bonds today when creating a diversified portfolio?
So, I think you're right, Austin, that bonds play a very important part of an overall investment portfolio. But, I think also if you ask a lot of investors, what are the bonds there to do? They would simply say they're there to diversify my equity risk. And they do that over the long term. But as you mentioned, if you kind of look in shorter periods of time, for instance, if you take a look at the rolling 3-year correlation between equities and fixed income, that's pretty variable. Like long term, the correlation between stocks and bonds is about 30%. So, okay. But if you look at the rolling 3-year correlation, you find sometimes extended periods in which that goes as high as 68% or even 70%. And then you find some periods when it's actually negative. But what I think that calls out for is the idea that you diversify beyond two things. There's the old saying, don't put all your eggs in one basket. I'm not so sure that we're so much better off if you put your eggs in two baskets. You would want to do, I think, more than that. And the investment universe is expanded to the point that there is more to do than simply stocks and bonds. And also the investment universe is expanded in such a way that those things are available in accessible ways, not always just private funds with AI and QP requirements. There are now investment vehicles that will provide access to additional diversifying return streams, but in a mutual fund form factor that's available to a wider swath of the investing public.
Right. Henry, I'd love your perspective here too. When we're thinking about building portfolios for clients, how do you think about the role of bonds today?
Well, there are times where bonds are like anything else are very attractive and sometimes not so attractive. Again, like stocks, interest rates go through long secular cycles. Current yields now with a 10-year yielding 4.4% to people who experienced the financial crisis and saw 0% interest rates and negative rates in certain parts of the world. That 4.4% sounds terrific, but historically yields have been much higher. So bonds aren't necessarily as simple as an investment that people might think they are, because you long-term bonds, sometimes they just really don't compensate you risk-wise over the term of the investment. If you hold the maturity and you're in a safe security, you'll get your money back. But in the meantime, at certain yields, it doesn't buffer the rod. And I think that's where what Allen is talking about within the alternative universe really comes into play today. I mean, it probably always has, but there are more ways to participate in that today for the retail investor and in many cases the institutional investor. There was always a very small universe back in the day when David Swenson started researching the space at Yale. It's grown today, and it's also become, I would say, the alts area has become more diversified. So, I mean, right now, to me, bonds they're okay, but they're not at a level where if we got into a difficult stock market environment that was caused by inflation and rising interest rates, that bonds are going to make you feel that comfortable.
Right. So, and from what I'm understanding from you guys, it's not necessarily that bonds are failing investors in recent times. It's that they're doing what they're economically supposed to do, but maybe investors have the wrong expectations up front.
I'm not, if you're investing in a high quality, top rated piece of paper, I'm not saying it's your principal is at risk, but it doesn't buffer the ride much. And in comparison, when you're putting an asset allocation together, you may have a sort of a policy framework and a guidepost to work through, but how you might weigh certain things at certain times. Certain assets are more attractive than others. And I would say where Allen is managing money now, I think it's relatively safer in the sense than bonds.
Sure. So bonds still matter, just to wrap up the 40 side of the 60-40. Bonds still matter. They're still an important diversification tool, and you can argue belong in many different types of portfolios, but it's probably unrealistic, or I guess it's fair to say that it is unrealistic to believe that out of all the investments available to us now, bonds represent the entire diversification toolbox. They're one tool, but not the whole garage.
Right. And I'm talking bonds. I'm not talking T-bills or something like that. I'm talking instruments with maturity issues and duration issues and things like that. And I'm looking purely at return, not a safety factor.
Right. Right. So one of the things I want to spend time on is this idea that portfolios are concentrated in a tiny sliver of the total investable universe. And I think this is where the word alternatives gets confusing, because a lot of things marketed as alternatives are really just traditional market risks wearing a fake mustache. They may sound different. They may take on a different spin, but underneath they may still expose investors to risks tied to stocks, credit, or the economic cycle. So when you are looking beyond traditional stock and bonds, what exactly are you looking for? Is there a checklist you use to determine, or I think you did mention earlier, there was a checklist you guys used to determine if a specific asset class or strategy is worth considering as a portfolio diversifier?
Yeah, there most certainly is. As I mentioned, we look for strategies that have a persistent and pervasive positive expected return, which to us just means that the return is positive in expectation, regardless of what's happening in the broader market. In other words, it's positive in expectation, regardless of what Fed interest rate policy is, regardless of the current inflationary environment, regardless of whether it's a bull market or bear market for stocks. We look for things where there's an intuitive rationale for profitability. And alt doesn't mean that it has to be this black box investment where you kind of can't tell what's happening and what's driving profitability inside of it. And then we look for things that have exhibited a really low correlation to stocks and bonds over time. That's a very easy filter to explain. As I mentioned, it turns out to be a really hard thing to actually pass through that filter. We found about 10 things that meet that test. Probably the easiest example of that is to provide catastrophe reinsurance in an investable form. And what is that? Effectively, our investment vehicles step into the shoes of a reinsurance company and provide a risk transfer service in exchange for the receipt of premiums, just like any insurance company that you're familiar with would do. You receive premiums in exchange for taking on the risk that you would have to pay claims in a very specific event. In this case, it's a natural catastrophe event, like a wildfire or a flood or a hurricane. Those things, of course, are not risk-free. You wouldn't expect to be compensated if there wasn't any type of risk undertaken. But to us, the thing that's key is that the risk that is undertaken is completely distinct from what's within your traditional 60-40 portfolio, and therefore diversifying overall.
So the power there, I mean, it's not that you're not taking on risk, right? You're earning a return because you're taking on risk. The power there is that a major stock market decline doesn't cause a wildfire, or the Fed increasing interest rates substantially over a short period of time doesn't cause wind damage. So structurally, you're picking up an uncorrelated return stream.
That's exactly right. And in the case of natural catastrophe reinsurance, I think to say it's uncorrelated almost understates the diversification that you get from it. The return stream is just unrelated. There's just nothing to do with what's driving returns in your stock and bond portfolio.
Right. And historically, what type of return does that look like? We don't need to talk specifics, but just to give a point of frame here, are we looking at 2%, 20% annualized returns, 10%?
Yeah, probably like over the long period, a high single-digit return, sort of akin to what you might expect in a high-yield bond, is something that you could achieve in a reinsurance strategy. But I would emphasize that there's sort of multiple flavors in which you can actually implement that exposure. So we kind of run the gamut of what's possible there in the vehicles that we manage at Stone Ridge. In certain cases, we're really gearing a lower volatility return experience for investors. But in other cases, we're willing to provide a much higher octane version of the same. Kind of in that higher octane version, the returns are maybe more like high teens, even into the low 20s. But that doesn't come for free. It's in exchange for taking on a little bit extra risk.
Sure. So just like the stock market has small cap, large cap, mid cap, the reinsurance market has different flavors of the asset, right, that come with different expected risk and return profiles. Yeah.
And, one way to think about that in a way that I think is relatable and kind of gets to this idea that we like return streams that are intuitive. Most investors have experience with insurance. You purchase insurance in your own daily life, of course. And I think most of your clients would not think that they're getting a great deal on their insurance policy. You're kind of buying it because you have to. It's typically quite expensive, and it's undertaken with the full knowledge that the insurance company is expecting to make money on your policy on average and over time. But in essence, you're paying to have an unacceptable level of risk in your personal life transferred away, like whether you insure your home or your car. The way that we can implement these reinsurance strategies in a way that kind of meters the risk, in essence, is looking at what is the deductible associated with those insurance policies. Just like you would find in your own, say, like homeowner's insurance policy or auto policy, if you're willing to accept a higher deductible, the premium goes down. And why is that? In essence, you're retaining a little bit more of the risk, and the insurance company has a little bit more of a buffer before they start to participate in any of the downside. Reinsurance investments can be structured in a similar way. You can invest in things like a catastrophe bond, for instance, that effectively just has a higher deductible. In exchange for that lower volatility, that lower risk, has a little bit lower expected return. But you can also invest in other things that are a little bit lower deductible, and in exchange for that, you would expect to receive a higher premium.
And you make a good point there. Nobody buys homeowners insurance or flood insurance because they think they're going to turn a profit off of it, right? They know they're going to lose money, but for them, it's acceptable because while it's a it's likely a low probability risk, it's a high risk for them, so they're willing to pay some money to offset that risk.
I think that's exactly right. And that phenomena exists beyond natural catastrophe insurance. It exists in financial markets as well, where a significant number of companies in the United States purchase price insurance. They don't call it that. They would say that they've hedged their interest rate risk or have hedged their exposure to copper prices or have hedged their exposure to fuel prices. In essence, what they've done is purchased some kind of an insurance policy that protects them against volatility within those markets. And similar to any, auto insurance policy or homeowners insurance policy, those premiums are priced at a level where the provider of that hedge does so at an expected profit.
So what do you say to the listener who's saying, you know what, this sounds pretty interesting, but then, flips off this podcast, turns on the Weather Channel and sees the next big disaster coming, right? And says, wait a second, well, maybe now's not the time to get into reinsurance.
Right. And based upon what's typically written or what you can see in the media, that's understandable. And of course, a lot of people would also ask, well, what about climate change? There seems to be more natural disasters than there was in the past or than there were in the past. First of all, the data actually doesn't support that. There's not more hurricanes now than there used to be. I'm not trying to deny that there's any type of climate change. Maybe there is, but to the extent that that's happening, it's a multi-decadal cycle. It doesn't just change by next year or even the year after. It takes decades to happen. And reinsurance premiums are reset on an annual basis. So there's just a significant opportunity to reprice risk as necessary to reflect whatever may be happening in the natural environment.
My impression always was that there is an element of real smart money in the reinsurance market, and that there's a lot of sloppy underwriting out there, and the smart money capitalizes, and it's like just assessing any other thing with risk reward, the price you pay, and all that. I mean, Berkshire Hathaway obviously has done it extremely successfully all those years, and they've had those tight underwriting standards, and they take advantage of the pricing and that whole element, and it's really completely unrelated to any other aspect of the overall business. It's an element of their asset allocation in a sense.
Absolutely. And I think one of the things that Berkshire Hathaway has done very well over time is respond to, what might broadly be thought of as dislocations in the market. But that's a fancy way of saying they are very acutely aware of supply-demand imbalances. And within the insurance industry, what that means is they're acutely aware of when there's a significant demand for reinsurance that gets paired with an inability to actually meet that demand. And as would be the case in any capital market, the way that resolves is simply at a higher premium level. And Stone Ridge has also, over the past 14 years, spent a significant amount of time and effort developing relationships within the reinsurance industry that allow us to be able to respond to these dislocations when they occur. One of the more recent examples of that was following a significant hurricane in Southwest Florida in September of 2022. It was Hurricane Ian that was about a $50 billion insured loss in Florida, and it really put significant strain on the reinsurance market in Florida. The way that resolved ultimately was through significantly higher premiums and significantly higher deductibles, which in essence just put investors in the reinsurance space in a better risk-adjusted return position going forward. In essence, you're receiving more premium and the deductibles had expanded, protecting you from smaller losses along the way.
So at the baseline, insurance companies aren't a nonprofit, right? They're there to make a profit. If expected risk starts to rise up over the years for whatever reason, whether that is climate change or some other reason, the premiums that they're pulling in would be expected to rise as well, because it wouldn't make sense for them to operate as a business if they planned on operating as a loss. So at the baseline, there is that return potential. And then what you're telling us is there's also ways to tilt the allocation to take advantage of better risk return opportunities as the world develops and those opportunities kind of get uncovered by the way the market's pricing itself.
Yeah, that's right. I mean, we like insurance-like strategies as an investment. And part of the reason why we really like them, in addition to the fact that they're uncorrelated with traditional assets, is that it has something of a self-healing mechanism built into it. And what I mean by that is simply that when insurance companies typically experience a loss, they in essence pay claims that are in excess of whatever premiums they received. The next time they get a chance to renew that policy, they raise rates. And anyone who's ever filed a policy or a claim on their auto insurance or home insurance has probably lived through that. The insurance company pays the claim and then raises your rate. From an investor standpoint, that's a very beneficial thing. You pay the claim, but you also are in a position to recoup that loss at an accelerated pace over time.
Right.
What I really like about it is it's so unrelated to the day-to-day stuff about what's the Fed going to do. Coca-Cola missed earnings by a penny. All that. It's a completely different universe.
Right. Right. Some of the calmest people at Stone Ridge during the first quarter of this year, when significant geopolitical tension as a result of what's happening in the Middle East and equity market and bond market declines, the pulse, the heartbeat rate of our reinsurance portfolio managers remain very steady. There's just nothing happening with the weather, and they kind of had a very smooth ride through what is pretty volatile period for traditional investments.
Sure. Now, I'm assuming you're not advocating for investors to put all of their money into one policy, right? Can you just quickly, from a geographic, from a insurance type, what that may look like?
Yeah, that exposure, it's exceptionally important that be a highly diversified exposure. Like what you would want to see is a very large number of small risks, because inevitably there will be claims to pay. And so the idea is to create a portfolio of investments where when those claims do need to be paid, it doesn't create an overly large impact within the investment itself. And that actually gets to another point that I think is key for alternatives, and particularly for investors for whom alternatives exposure is sort of a new thing, is that I would argue that a multi-strategy vehicle is the best mechanism to achieve that initial investment. And the reason why I say that is that the multi-strategy vehicle simply tends to be less volatile. And I would argue that at least psychologically, that's a pretty important place to start for an investor that may not have exposure to alternatives today. Like, start with something that is a relatively smoother ride. And a multi-strategy fund, if constructed correctly, that contains multiple strategies that themselves are uncorrelated, you simply can achieve a pretty significant diversification benefit within that multi-strategy fund that dampens volatility while preserving returns.
Right, which is very similar to using stocks and bonds, simply using the bonds to help diversify that return pattern, make that ride a little bit easier to take.
That's right. the trick and kind of the key is to create a portfolio of alternative investment strategies that exhibit a stable and near zero correlation with one another. Meaning that, if the average is zero, if you look over shorter periods of time, it's also close to zero. So for instance, we found you can pair things like natural catastrophe reinsurance with single family rentals with exposure to post-war and contemporary art. Like those are just three things that we've, kind of found that meet that three-part test that I described. But in addition to exhibiting a near zero correlation with traditional assets, they also exhibit a near zero correlation to one another. And so the combination of those things within a multi-strategy fund can be really powerful.
Right. Very interesting. So you mentioned about 10 asset classes. I don't want to cover each and every one of them. And you just mentioned a few more. And we are already, 30, 40 minutes into this. But maybe can you jump into, one or two other alternatives?
Yeah, we really like what we call alternative lending, or some others might refer to as marketplace lending. But it's providing credit to high quality consumers and small businesses. These are sort of the type of loans that your local bank might have originated historically. They tend to be relatively smaller in size, say like $10,000 or so, but issued to a consumer that has, say, a FICO score of 700 or higher. Those loans tend to have a significantly higher yield, and just as importantly, a significantly lower duration than what you would find in a traditional fixed income portfolio. And so they're diversifying as a result. That lower duration means they're much less sensitive to what interest rate policy is more broadly. And the diversification potential of that was really on display in 2022, a year that was just very challenging for traditional fixed income as the Fed engaged in a rapid rate hiking cycle. But our alternative lending strategies were positive contributors to portfolio returns through that period as a result of that higher yield and lower duration profile. Single family real estate or single family rentals is another example of what we think is a really powerful and diversifying alternative investment return stream. We would really seek to think about the rental yield associated with those properties. So, any real estate investment that's held for rental purposes ultimately might have two sources of return: home price appreciation or depreciation, and whatever you receive in rents over the period of time that you own that property. The home price has typically been a relatively more volatile component in the equation. The rental yield has historically been very stable and very non-cyclical. And so we seek to sort of isolate that component of the return stream. It's also diversifying because typically what you can get exposure to in real estate in a traditional portfolio is through a REIT. So you get significant equity market beta associated with those things. And it also tends to be either commercial or multifamily properties. So we like the fact that this single family real estate provides exposure to rental yields associated with that segment of the market. We're also really excited about exposure to post-war and contemporary art. Stoneridge is the only asset management firm that's ever had a mutual fund that provided that type of exposure. It's an example of a return stream that just is completely unrelated to what's happening in traditional assets.
So when you basket all of these uncorrelated return streams together, what type of return pattern would you expect? Right? Obviously, historically, you can't take historical returns and say this is how it's going to work indefinitely for the future. But by adding these different pieces together, is there any context you can provide our listeners in, what that risk return stream may look like, or what, perhaps, the way that you're allocating your target risk return stream?
Yeah, I think you can combine those return streams in such a way that it ultimately gives you a bond-like volatility and potentially even a lower than bond-like volatility. But that is a function of the fact that you've combined multiple uncorrelated return streams. And ultimately, what you've done is harvest a significant diversification benefit in terms of a reduction in volatility while preserving the positive return potential of all of the individual strategies themselves. So, we to kind of summarize it by saying you can create an equity-like return, but with a bond-like volatility and a very stable, near zero correlation to traditional assets.
Very interesting. So I think it's important just to take a breath here and just to make sure we emphasize with the listener that just like bonds are not the perfect diversifier, neither is any one specific category within, what you may call a realm of diversifying asset classes or strategies. And the importance in, being able to combine them in a way that can offer more chances for diversification in more situations. And it's not so much one needs to be better than the other. They all offer, unique characteristics, but when you combine them, like you may in a multi-strategy fund, or you may from just a portfolio allocation setting, you really pick up the benefits there.
Absolutely. And I think that's true at the portfolio level as well. I mean, what I'm describing in terms of our own alternative investment strategy, I think they're all fantastic strategies in and of themselves, but they are not magic strategies. They do take risk in order to, seek a positive return. And they will occasionally experience drawdowns. The idea within a multi-strategy form factor is that those drawdowns are relatively more shallow and easier to kind of tolerate. As a result, they kind of try to help investors do the work of being able to maintain the course and not sort of engage in that circumstance where you sort of chase returns higher and then you wind up selling lower. But what I think is that it is a valuable part of an overall investment portfolio. Like maybe if you started at your 60-40 investment portfolio, you would consider a portfolio construction that's still 60% stocks, but is 30% bonds and 10% alts, or 25% bonds and 15% alts. It's just a part of the toolkit that you can bring to bear within an overall investment portfolio that I think ultimately will achieve a better outcome for investors.
Right.
I mean, it really is. It is a long-term concept.
Right.
It's not something that you flow with the breeze, no pun intended. But I mean, it's something like an asset allocation that you must have the discipline to commit to a strategy for the long term, because stuff happens.
That's absolutely
and you can count on that. But
you can count on that.
Right.
But that kind of, and I sort of mentioned this previously, that I thought for investors for whom this might be a initial investment in alternatives, that in essence, it's important to be cognizant of the fact that as a result of the fact that an alternative by definition is somewhat new and somewhat different than what's in a traditional portfolio, the risk tolerance associated with that investment is going to be lower. Like, people have a risk tolerance this big for stocks and bonds. It's going to be this big for alts. We would seek to just meet them there. I'm not going to try and talk you into something else. You start by delivering an investment that you think that investors can really tolerate and hold from a risk standpoint. What we've also found is that over time, as investors become more familiar with alternatives, that risk tolerance grows. Typically, the allocation within their portfolio grows. But we're big proponents of the idea that you sort of crawl, walk, and then run. You don't have to start out running.
Right. Right. And you could see that just by looking back in history. At one point in time, emerging market stocks were almost considered, they were in the realm of alternatives, right? Or micro cap US stocks, which are in a lot of small cap funds now, were considered alternative. Now we think of them as stocks, right? We think of them as normal parts of our lives.
Absolutely. I mean, that is just a pretty consistent trend, I think, throughout sort of investing history. Maybe a very, more recent example of that is that if we were having this conversation 5 years ago and I said the word Bitcoin, it probably would have caused like significant eye rolling. And now they're available in ETFs and, it's becoming an increasingly common holding within institutional portfolios, a much more mainstream asset. It's happened over just a few years.
Right.
I think the thing people forget is that actually it will enhance your long-term returns. It's that simple.
Right. Now, one more, bigger item that I wanted to cover just to stay ahead of any confusion, because I think there's a lot of confusion around it, is correlation. And the fact that correlation is not an end all be all. Just because something is structurally uncorrelated doesn't mean at times they can't be down together or up together. For example, if me, Henry, and Allen are flipping a coin, it is very possible that they all land on heads, but we're also in all different geographies right now. We're different people. We're going to flip it at different heights, right? There's all these factors. It should be structurally uncorrelated. When a heads will pop up for me versus Allen versus Henry. But the fact of the matter is there will be times when all three of us flip and we get heads.
That's right. I think that there is, and I'm glad you mentioned that, Austin, that there is occasionally a misconception that if you think you've identified an investment that is uncorrelated, you think that you found a hedge, that thing is going to go up when the other thing goes down. And that's just not what we're saying when we say that there's zero correlation. Effectively, what you're saying is that there's just no relationship between those two things. They're not dependent variables, but it is entirely possible, as you say, that two things that have a zero correlation with one another could go down at the same time. They could also go up at the same time. What the correlation is just trying to tell you is that behavior is independent of each investment.
Right. So, Allen, I could talk to you for hours, and I think we certainly have over the course of the last year plus. But we simply just don't have the time today. So, if listeners are looking to remember only one or two things from this conversation, what should they take away?
Yeah. So, I think it's really two things. The first is that an alternatives allocation deserves a place in your investment portfolio, but it doesn't have to dominate your investment portfolio. It can be 10 or 15% of your overall holding. And I also think that the takeaway should be that not all alternatives are the same. And so a very kind of convenient or easy place to start that filter is simply to look at the correlation between your existing portfolio and the alternative that you're considering adding. Sure.
And then if investors or advisors listening want to learn more about topics like these, where should they go? Where should they start?
Yeah. So one place that you can go very easily is to Stone Ridge Asset Management's website, which is stoneridgeam.com. We have quite a bit of educational material available there as a starting point.
Great. And then we like to close out each episode with a what's new bit, take us outside of the realm of financial lingo back into just being people sitting in front of probably really expensive laptops and technology, but people all the same. So is there anything new you've read or watched recently, or perhaps there's a trip lined up you're excited about, maybe a new hobby? What's going on in Allen's life?
Yeah. Very excited about a trip at the end of the month. My wife and I are going to go to Northern Europe, to Sweden and Denmark, two places that I have not been previously. Just a great opportunity to kind of decompress a little bit and see some new parts of the world.
Awesome. Is that a busy time of the year for those areas?
Our hope is that we're a couple weeks ahead of the peak.
Okay.
But I expect we won't be the only ones.
Right. It's like investing. You have an instinct and based on what you're reading, but everyone's reading the same information.
Right.
Plenty of midnight sun, Allen.
Thank you.
Great. Yeah, me and my family were heading off to Banff, which I'm pretty excited about.
Oh, nice.
The pictures look beautiful. It appears that it's going to be a bit of a pain to get to, but from what I understand, well worth it. So we're excited about that.
I've wanted to go visit there multiple times and have not quite ever managed to do it, but look forward to hearing about that.
Yeah, for sure. Well, thank you, Allen, for joining us today. Henry, for joining us as well. To our listeners, please remember to like, follow, and share all that fun stuff to fool the bots that we deserve to be listened to. And we look forward to talking to you next time. Thank you.
Super. Thanks, Austin. Bye,
Thanks,
Henry.
Alan.